Hello, and welcome to the Geopolitics Explained podcast. Over the last few weeks, we've been discussing the recent escalation that we saw in the Middle East, specifically between Israel and Iran. The last episode of the Geopolitics Explained podcast covered potential scenarios that could unfold for both Israel and Iran in the future in the Middle East. It was an almost 50-minute episode, so if that takes your interest, I would recommend going and listening to that episode after this one. With de-escalation temporarily being seen in the Middle East, in what will be a slight change of pace, I will leave the Middle East behind and return to discussing Europe as we were before the escalation in the Middle East. Specifically, we'll explore the European Union and the Eurozone, and who is responsible for monetary policy, fiscal policy, and sovereign debt. To start, I'll provide some definitions so we're all on the same page. Firstly, monetary policy is how a country, or in this case a group of countries, control the supply of money and interest rates to influence the economy. The goals pursued through monetary policy are to control inflation, to stabilise the currency, to support economic growth, and to maintain employment. Fiscal policy is how governments raise and spend money to influence the economy. The goals here are to manage economic cycles, fund public services, support jobs and investment, and reduce inequality or debt. Finally, sovereign debt is the money a government owes to domestic and foreign creditors. This typically comes from issuing bonds, where investors lend money to governments in exchange for a return at a later date. Debt to GDP and credit ratings can measure a country's sovereign debt risk. If they have high levels of debt, this can lead to a distrust in this country's bonds. In the worst cases, it leads to debt crises and defaults. All three concepts are vital economic concepts in any country around the world, but in Europe, where the Eurozone and the European Union are incredibly ambitious projects, these concepts are even more important. So, how do these aspects work within Europe, and how can they be improved? Let's dive in. We first need to mark the difference between the European Union and the Eurozone. Firstly, the European Union is a political and economic union of 27 European countries that have agreed to integrate trade, law, and climate policy, as well as other elements on a lesser scale, such as foreign policy and security policy. The Eurozone is the monetary union of 20 European member states that have adopted the euro as a currency. And as a result, they share a common monetary policy of the European Central Bank. This difference between the European Union and the Eurozone ensures differences in the countries within Europe that are either a part of none, one, or both of these groups. So, with that distinction explored, we can now dive into monetary policy within Europe. The 20 countries that use the euro share monetary policy through the European Central Bank, also known as the ECB. It is the ECB that sets interest rates, manages inflation, and controls the money supply for the Eurozone. There are 7 European Union countries, which include Poland, Hungary, and Sweden, among others, that retain their own currencies and central banks, and as a result, they control their own monetary policy and interest rates. The tension that this creates in the Eurozone is that monetary policy doesn't fit the different economic conditions that differ across Eurozone member states. As a consequence of this, more tools are necessary to ensure individual member states can manage their national economies according to their own incentives and interests. For example, what Greece needs in terms of monetary policy is different from what Germany needs. because fiscal policy and sovereign debt characteristics of both of these countries differ. But as I stated, the tools are lacking. Allowing different monetary policies for Eurozone members is difficult because they all use the euro as currency. But what connected mechanisms could give them more options in times of crisis? Firstly, there could be longer-term refinancing offered to struggling nations. This would involve offering cheaper loans to banks under strain in an attempt to incite economic growth through more spending. This could also be connected to banks in nations with high unemployment or weak credit growth. Secondly, we could allow national central banks of Eurozone member states to accept a wider range of assets as collateral for repayments, which could in turn stimulate local credit. However, this could also increase credit risk and so would require strict control and oversight from the ECB. There could also be regional quantitative easing. We saw an example of this during the pandemic when the Pandemic Emergency Purchase Programme rerouted capital to help Italy and Spain because bond spreads were widening between nations in the Eurozone. This strategy could become a permanent part of ECB policy during shocks. And finally, national central banks could also promote lending from banks or private investors to innovative projects using tailored incentives or risk-sharing instruments. This would encourage innovation without seeing currency fragmentation. Another key point to explore when discussing the Eurozone and the euro is the status of the euro as a reserve currency asset. As of Q1 2025, IMF data had the euro making up between 19 and 20% of global foreign exchange reserves. This makes the euro the second most held reserve currency in the world, behind the dollar. There are many characteristics contributing to this, but this is largely because of the size of the Eurozone, with 340 million people using the euro. Also, the European Union and the ECB are seen as stable and credible institutions, and many Eurozone government bonds are widely traded and trusted. This leads to countries that aren't part of the Eurozone but are in Europe, especially in the Balkans, adopting the euro as legal tender because it is more stable than their currencies. This is seen in Bosnia and Herzegovina and Montenegro, among others. Moving forward, if the Eurozone could address some of the fragmentation within monetary policy via some of the strategies discussed in this episode, some tension within the Eurozone could be reduced. However, one way that the Eurozone remains incredibly fragmented by design is in fiscal policy. Fiscal policy in Europe comes down to national governments who control spending, taxation, and borrowing on an individual country basis, with some low-level coordination existing. One such example of this coordination is the Stability and Growth Pact, which aims to keep deficits of European Union members under 3% of gross domestic product and debt under 60% of gross domestic product for each country. But these rules are outdated, rigid, and weakly enforced. So instead, Europe could pivot to focus on innovation, not arbitrary numbers. Europe is also deemed to have a productivity problem, which I'll discuss more over the coming weeks, but investment in positively returning projects could help boost productivity within Europe. Especially in vital areas such as defence, the digital realm, and energy. Spending currently is included within these fiscal rules and limits of 3% deficits and 60% total debt to GDP. But if these vital areas were exempt from fiscal rules, this could start to encourage Europe to escape this productivity trap. Another example of coordination in fiscal policy among European Union states was the Next Generation EU project. This was a temporary recovery instrument created by the European Union to respond to COVID-19. It aimed to support reforms and investment in the states that were hit hardest by COVID via methods such as digital transformation, health systems, and crisis preparedness. This is notable because this was the first time that the European Union borrowed on scale from financial markets in a collective approach to help all 27 member states. And it was thus marked as a potential paradigm shift towards shared fiscal policy in the future within Europe. However, until there is a shared Eurozone treasury, there is no true fiscal union. So currently, all fiscal decisions continue to occur on a national level within Europe, but Eurozone countries are subject to some of these extra rules that we've discussed. Fiscal policy reform is one of the most critical reforms that could make the European project more resilient in the face of crises. A central fiscal authority could also collect common taxes, such as carbon or digital tax, and they could issue joint debt or redistribute funds during crises with more ease. This change could encourage fiscal policy that aligns with the short-term debt cycle, where Europe could spend during recessions to improve the negative growth environment, while saving could occur during periods of economic boom. This would give Europe more options, and as we've seen over the last few months since Trump entered office, Europe can't be relying on other countries forever. Further challenges still remain here related to sovereign debt. Fiscally conservative countries, such as Germany, would likely have to step up for those in less favourable fiscal situations. It's here where sovereign debt enters the picture. So even though the Eurozone countries share the euro and follow monetary policy that is set by the ECB, each country still borrows money on its own by issuing bonds to investors. Discussions around joint euro bonds in general have met resistance, especially from Northern Europe, who typically have more developed debt markets. The different levels of trust and debt sustainability in individual countries have left European markets fragmented. More frugal nations worry that if debts were mutual within Europe, nations with more debt wouldn't be incentivized to maintain fiscal discipline because other nations in the group would be forced to bail them out. In this case, shared debt could increase the risk of borrowing for frugal nations and could negatively affect their fiscal policy at no fault of their own. But there are solutions here also. Most importantly, in a big picture view, even fiscally frugal nations such as Germany support centralised fiscal power, but they want this to occur cautiously and in small increments. This cannot occur overnight, especially if these frugal nations are to be protected. But there are other nuanced strategies that Europe could pursue outside of a slow, cautious approach. Eurobonds wouldn't need to be a singular collective. Firstly, there could be blue bonds that could include safe EU bonds from frugal nations, and red bonds that could include nations whose debt is seen as riskier, but investment in these would offer a greater return. Which countries to include within which groupings could be calculated as simply as through credit ratings provided by Fitch, S&P and Moody's. This would lower the risk during debt crises for the European states in better debt positions, but it could also lower borrowing costs for weaker economies if a carefully created bond structure was established. There likely isn't a one-bond-fits-all solution here, but a layered solution could offer broader benefits for a larger number of states. A layered bond solution could even be targeted towards sectors within the wider European Union. For example, in the defence industry, introducing European defence bonds, especially at a time where Europe is seeking rearmament, could be a way that sovereign debt becomes more shared within the Eurozone. Also, at the moment, there is growing rhetoric and risk surrounding US treasuries. For investors who want a risk-free asset from the European Union, risk being spread over multiple European Union states could be a very attractive asset. This could also raise the status of the euro as a reserve currency. Of course, the dollar won't be uprooted overnight, as we've discussed countless times here on the podcast, but the trend of de-dollarization has begun, and it started when the United States confiscated Russian foreign exchange reserves that are held in dollars. If Europe did create a sovereign debt structure such as this, the euro could also benefit here. Outside of specific policy approaches or changes that Europe could pursue, there is a final, deeper psychological pivot that Europe could take. If we look at China, they typically take a long-term view of multiple elements of their domestic policy. On the flip side, the Europeans usually follow the same method as the United States, where short-term pursuits attempt to fix issues as they arise. This strategy from the United States is reactive, and generally it is indicative of a declining geopolitical power. The Chinese incorporate a preparation strategy, and in the long term, this places them in good stead to better weather challenges and crises when they arise. It's not guaranteed that they can weather all storms by using this approach, but through longer term planning, they are better aware of worst case scenarios that could emerge before they do, and as a result, this gives them more options. As our geopolitical world is realigning under Trump and his power-based world order, Europe has an opportunity to realign and focus on the long term. Based on today's discussion, this could involve multi-year fiscal plans that are tied to the European Union's longer-term strategy goals, or it could be a long-term roadmap and structure towards European bonds. As the United States and the European Union undergo a redrawing of relations, Europe has a chance to forge its own path and to make it one that is successful. This would involve a long-term plan, and the longer term the plan, the better. That's all for today. I've been Dylan. I'll talk to you next time.